it away.
Well, thank you, April, and happy to join everyone today. As April indicated, I over the past 20 years, one of the main roles that I've held here at Catalyst is to help our clients either sell or buy businesses. And these are, I work in the owner-managed space and generally in the mid-market. So that's a bit of the context of the type of work that I've done. So, you know, the question for today is, does buying a business make sense? And, you know, it depends, like any good professional. I'll start with it depends, but generally it does, often in that you have an automatic track record, you have cash flow. Financing is easier to get than a startup when you're acquiring a new practice generally. And quite often you can get vendor assistance or the old owners to help out, maybe carry a bit of the purchase price. But at the same time, you can't lose sight of there is a cost, and especially if there's a significant goodwill portion to the value, whether or not it's the right fit and your ability to integrate this business. And, you know, it does depend on how important the old owners are to the business, and, you know, the ability to transition to you, the new owner, that's critical. So when the topic of businesses for sale comes up to me, I think you need to start with looking at supply and demand. And quite often in today's world and where we are, it comes down to boomers and demographics. And so we've all seen the statistics, and, you know, 60%, according to BDC, a survey 3 or 4 years ago, you know, 60% of small business owners are over the age of 50. And we might even be closing in on 55 or 60 now, just because this was a 3 or 4 year old survey. So of those, you know, about 40% of entrepreneurs expect to exit their business, and about half of those businesses would be available for sale. So, you know, good news for sellers, I believe, is that there are entrepreneurs such as everyone on the call today that might be interested in looking at these businesses for sale. But for you on the call, I think that it is a bit of a buyer's market right now, and probably for the foreseeable future. And then, of course, you can't talk in our current time without referring to COVID and how that's impacted things. I did see a Canadian Federation of Independent Business study a couple of days ago, and said that 42% of small business owners have delayed their retirement because of COVID, and 55% of those surveyed said they believe their business value has dropped because of COVID. And in some ways, I'm surprised that number wasn't higher than 55%, but that's what the number was. So COVID definitely over the last year, I've seen it, but, you know, in some ways it has had less impact on purchase and sale of businesses than maybe I was expecting. It still has an impact, obviously. Values, I believe, are down, and maybe more a function of cash flow being down for that particular business than maybe multiples being down. And it's generally harder to do due diligence in today's COVID world. You know, another BDC survey, this was a year after, kind of saying the reasons that people are looking to acquire another business. Nothing really jumps out as surprising to me here. You know, probably the bottom three, expanding geographic presence, adding a new business line, or increasing market share, are generally the three that I hear the most when I talk to clients. You know, I've seen kind of the list of upcoming topics that Village Wealth has, and a lot of these steps in the business acquisition process are going to be covered over the coming weeks and months. So I'm just going to do a pretty high overview today, and we'll let others speak in more specifics about some of these topics in future presentations. But you know, the process to me is first of all, define what you are looking for as a potential buyer, and then you start your market canvas. You do the preliminary review of the target business, and at the same time challenge the valuation, and also determine how you're going to fund the purchase. And at that point, then you decide whether you're going to make an offer. If it's accepted, you move into due diligence. And if you like what you see, then you'll work on the closing documents, the share purchase agreement or asset purchase agreement, close the transaction, and then there's going to be the transition period when you are the new owner of the business. Not totally sure who is listening in today, but you know, I'll start with a potential strategic acquisition that you may look at. And generally this is for if you are already active in the business or in, in the industry, and you may already have a business that you want to bolt on to this purchase. You know, you might be taking out a competitor, you might be moving upstream or downstream, and you're going to look to grow your team and that maybe add new products or markets and hopefully reduce cost as well for the overall business. But there's, you know, challenges with this strategy as well, you know, and it's the old risk, time, and focus, loss of focus potentially. And the potential with your existing business to maybe lose some talent, lose some people during the integration, just maybe they don't like where things are going or don't like the look of the new business as well. So that can always be a challenge. A second type of acquisition could be if you're a financial buyer, and by that, you know, you're looking for a new opportunity. You probably aren't a business owner at the current time, but you might be open to look at many different industries and ultimately looking for a business that provides you with an acceptable return on your investment. The potential cons on this strategy is that you might not know the industry as well as if you were already working in it. And it may, you know, you may rely more heavily on your management team and because you don't have that industry knowledge. The final type I'll quickly talk to, and again, back to maybe COVID, is the potential to look at distressed businesses or, you know, businesses that are close to bankruptcy, in bankruptcy, whatever it might be. So potential pros could be a lower price and the opportunity to take an existing business in a new direction. And there could be some legacy value with their products or brands or capacity. But, you know, ultimately, when you're looking at distressed businesses, the context is ultimately one of failure, you know, whether it's management's fault or COVID or a combination of the two. So there are a number of risk factors, and it's generally harder to secure financing for a distressed business. So how do you, moving into the second stage, how do you find these businesses for sale? Well, we're all on a Village Wealth sponsored call. So, you know, I would suggest that's probably your first stop. Talking with industry and social contacts you might have, other professionals, accountants, lawyers, bankers in your universe, and potentially talking to trade groups as well. And business brokers can be a very good source, finding these businesses, you know, review their websites, look at the listings they might have posted, and you can either and work with them on a passive search or an active type of a search. By passive, I mean they would essentially put you as someone that's interested in looking for businesses on their list and let you know of any opportunities that come their way. An active search is more that you hire the broker and they would go out and actively search for, based on your parameters, what you're looking for. A few front-end questions about the target you're looking at. Does the acquisition make sense for you? If this is a strategic purchase and you already have a current business, then what's going to be the impact there as far as on cash flows and the balance sheet implications and potential synergies that you might be able to reap with a tuck-on business as well. And ultimately, understanding what you're buying and why the old owner is selling, just to make sure that you're fully aware of what's going on there and any external factors that might be impacting the industry. This is, I would suggest, the time that you're going to undertake a valuation, your own valuation of the business, and probably working with the financial advisors that you have, that you're working with at the time. Valuations are going to be generally cash flow based, and you're going to understand and look at things like EBITDA, free cash flow. You're going to look at the balance sheet. Maybe you're going to consider synergies if you already have an existing business. Not saying that you're going to pay the vendor for those synergies, but it's good to understand them. And then also the understanding that what you pay is going to impact value, or how you're going to pay, I should say, if it's all cash, if it's going to be a combination of a vendor take back note or some type of an earnout. And also goes hand in hand with the valuation is start considering what your capital structure is going to look like and any debt financing that you require. Now's the time to at least start talking to your bank contacts, and so that they can be up and running should you get an offer accepted. And so this is the time when you decide ultimately, are you going to make an offer or not? Some results from the same BDC survey as far as why interested parties didn't proceed with acquiring another business. And again, nothing really too shocking here. The old economy was too uncertain. Well, this was back in 2018, but that's sure been magnified here in 2021. And then whether or not it's the right strategy for you and you're able to secure the financing or not were also big reasons for not proceeding. The offer, usually in the form of a term sheet or a letter of intent, non-binding at this stage, and it's going to touch on issues such as whether this is going to be an asset or a share purchase. You're going to put a price in your offer, and also how it's going to get paid, cash versus a vendor take back, where the old owner carries a portion of the financing. You should refer to what working capital is going to be required when you take over this business, and then other balance sheet requirements generally, that you're not going to assume any debt, or if you are, what it's going to look like. The offer, the term sheet, is generally where you're going to lay out, at least at a high level, what your plan is for the old owners and how you're going to transition this business from them to you, the timing, and then any other conditions that you're going to require to be met or waived prior to closing, such as financing, such as non-compete clauses and different things like that. And generally, if the vendor does agree to your offer, you will move into an exclusivity period where you can start your due diligence. I'm generally finding, and I think the market is as well, that due diligence seems to be taking longer, and that this was even before COVID. Yeah, I'm saying to clients that if all the stars align, it's hard to get a deal closed in less than 3 months. It can be done, but if anything is taking more than 3 months, then less, or at least that's what I'm finding. You know, you have to assemble your team that's going to help you with the due diligence, which is going to touch on financial and tax implications, operations and commercial due diligence, and then your legal counsel will help on the legal side. And ultimately, what you're trying to do is reassess and then confirm the deal terms that you had prepared in the letter of intent, and whether or not you're ultimately going to go forward and move to an exclusive deal, or pardon me, a final binding deal. Some of the other let's say, financial issues, but just as important, non-quantitative issues to tackle during due diligence are things, you know, like that, like I have listed here. What's the secret sauce of this business? You know, why do customers or consumers buy? What is the unique selling factor of these products or services that they provide? And ultimately, what is the company culture that you are going to essentially inherit if you acquire this business? And if you have an existing business and this is a strategic purchase, then what is the fit going to be with your hidden with your existing business? Pardon me. Closing paper, as I refer to it, these are the closing documents that your legal counsel will help you with. At this point, you're moving towards a binding agreement, a binding document, but it's going to refer to things like the payment structure and, you know, the reps and warranties that are essentially risk allocation and disclosures that are going to be provided. Covenants, which are essentially actions to be taken pre and post deal if reps and warranties aren't proven to be correct. Closing conditions, indemnities, and, you know, this will refer to compensation that might be paid if the disclosures are inaccurate. And then we also get into non-compete, non-solicit agreements with the old owners, and then just lots of other potential side agreements like potential lease or employee contracts, promissory notes if there's a vendor take back, or your lawyer will also help and look at any acquisition of control clauses that could be in some of the existing contracts of the current business that you're looking at. And then congratulations, you now own the business, and now you have to get into the integration planning, and whether or not you're tucking this into a current business that you have, or whether you're just you're a financial buyer and this is your business now, and you got to work on the plan to make it your own. And, you know, it's going to, all of these points here as far as forming your integration team and putting a 100-day plan into place and communicating with the current stakeholders and employees. This is probably where you're going to meet your customers and suppliers, and quite often it'll be meeting with them for the first time with the old owner where there is a transition provided, but ultimately focusing on your strategy and leaving your door open for questions with that will come with employees and staff and other stakeholders. So what are the most challenging steps? You know, I can echo just about everything that's on here, you know, everything from the letter of intent all the way through to retaining key employees and merging cultures, which was the number one response in this survey. But, you know, all of these issues have to be dealt with as you go throughout the process that I just laid out. So that was a pretty quick flyover of a fairly complex and can be time-consuming process. You know, what I would suggest or recommend is make sure you dig deep, and that's mainly in your front end and formal due diligence. Be patient. This isn't a quick process generally to go through. It's generally longer than, and when I tell clients at the front end, it could be a 6 to 18 month process. They kind of roll their eyes and can't believe me, but it more often than not, it does prove to be the case. You know, think fit, whether, especially if it's a strategic acquisition that you're looking at, but also, you know, how you're going to be able to integrate it and whether or not you have an existing business. That's a key. And an evaluator has to finish with a price it right comment that, you know, make sure that you do your front end work when you're putting the price together and understand exactly what it is you're buying, what the cash flows look like, and then how does that convert into a price. So with that, I'll wrap up and open it up for any questions or comments that people might have.